Is it possible to get into a new banking crisis? The global banking system is fragile and prone to instability, and with recent market fluctuations, it's no surprise that some experts are warning of another banking crisis. With so much at stake, the question has become, are banks set to fail again? In this video, we'll take a look at what the experts are saying about the potential for a new banking crisis, and whether it's a real possibility. What caused the last banking crisis? The last banking crisis, also known as the global financial crisis of 2008, was caused by a combination of factors that led to a systemic failure of the financial system. Some of the key causes of the crisis include: 1. Subprime mortgage lending. Banks and other financial institutions made large numbers of loans to people with poor credit histories, often with little or no documentation of their ability to repay. These loans were bundled into mortgage-backed securities and sold to investors, which spread the risk of default across the financial system. 2. Securitization. The process of bundling loans into securities made it difficult to assess the quality of the underlying assets, leading to a lack of transparency in the market. 3. Excessive risk-taking. Financial institutions took on too much risk by investing heavily in complex financial instruments like credit default swaps and collateralized debt obligations, which amplified the impact of the housing market downturn. 4. Deregulation. Financial markets were deregulated in the years leading up to the crisis, allowing banks and other financial institutions to take on more risk without proper oversight. 5. Leverage. Financial institutions were highly leveraged, meaning they held large amounts of debt relative to their assets. When the value of their assets declined, they were unable to meet their obligations, which led to a wave of defaults and bankruptcies. 6. Systemic risk. The interconnectedness of the financial system meant that the failure of one institution could have a domino effect, causing widespread panic and instability. The combination of these factors led to a systemic failure of the financial system, causing a global economic recession and widespread unemployment. Governments and central banks around the world took unprecedented actions to stabilize the financial system and prevent a complete collapse of the global economy. What has changed since then? Since the global financial crisis of 2008, there have been a number of changes in the financial industry and regulatory landscape aimed at preventing another crisis. Some of the key changes include: 1. Strengthened regulations. Governments and regulatory bodies have introduced new rules and regulations aimed at improving the safety and stability of the financial system. For example, the Dodd-Frank Act in the US and the Basel III regulations internationally have introduced higher capital requirements, more stringent risk management standards, and increased transparency and reporting requirements. 2. Increased oversight. Regulatory bodies have increased their oversight of the financial industry, with greater emphasis on monitoring systemic risk and detecting potential problems early. 3. Improved risk management. Financial institutions have implemented stronger risk management practices, including stress testing and scenario analysis, to identify and mitigate potential risks. 4. Greater transparency. There is greater transparency in the financial industry, with improved reporting and disclosure requirements for financial institutions, including increased disclosure of risk exposure. 5. Improved corporate governance. Companies are subject to greater scrutiny in terms of their governance and risk management practices, with an increased focus on the role of boards of directors and independent auditors. Overall, these changes have made the financial system more resilient and better able to withstand shocks. However, there are still concerns about the potential for future financial crises, particularly as new risks emerge in the rapidly changing landscape of the global economy. Are we at risk of another banking crisis? There is always a risk of another banking crisis, as the financial industry is inherently complex and subject to a variety of risks, both known and unknown. However, the regulatory and industry changes made since the last crisis have significantly reduced the likelihood of a similar event occurring in the near future. That being said, there are still several factors that could potentially lead to another banking crisis, including: 1. Economic downturns. Economic downturns can put pressure on financial institutions, especially if they are highly leveraged or have significant exposure to risky assets. 2. Political instability. Political instability, including changes in government or unexpected political events, can have a significant impact on financial markets. 3. Cybersecurity threats. Cybersecurity threats are becoming an increasingly important risk for financial institutions, as a successful attack could lead to significant financial losses and damage to the reputation of the industry as a whole. 4. Geopolitical risks. Geopolitical risks, including tensions between countries or geopolitical conflicts, can significantly impact financial markets. 5. Climate change risks. Climate change risks, such as extreme weather events or changes in natural resource availability, could impact the financial industry through disrupted supply chains, increased insurance claims, and other factors. While these risks are present, the financial industry and regulatory bodies are continually working to identify and mitigate them. Additionally, the lessons learned from the previous crisis have led to improved risk management practices, stronger regulatory oversight, and a greater awareness of the potential for systemic risks to emerge. What can be done to prevent another banking crisis? Preventing another banking crisis requires a multi-pronged approach that includes regulatory oversight, risk management practices, and industry-wide awareness. Here are some key steps that can be taken to prevent another banking crisis. 1. Strengthen regulatory oversight. Regulatory bodies can increase their oversight of financial institutions, including stress testing, monitoring of systemic risk, and early warning systems to detect potential problems before they become systemic. 2. Implement stronger risk management practices. Financial institutions should implement strong risk management practices, including diversifying their portfolios, limiting exposure to risky assets, and conducting regular stress tests to identify potential risks. 3. Increase transparency. Financial institutions should provide more transparent and detailed information about their operations and risk exposure. This includes enhanced disclosure of asset quality, risk management practices, and capital adequacy. 4. Improve corporate governance. Companies should have strong governance practices, including independent boards of directors, transparent decision-making processes, and effective risk management systems. 5. Promote industry-wide awareness. The financial industry should promote greater awareness of the potential for systemic risks to emerge and the need for strong risk management practices across the industry. 6. Enhance cybersecurity. Financial institutions should implement strong cybersecurity practices to protect against cyber threats, including investing in security infrastructure, conducting regular risk assessments, and training employees to recognize and prevent cyber attacks. Preventing another banking crisis requires a concerted effort from regulatory bodies, financial institutions, and industry stakeholders to promote strong risk management practices, transparency, and effective oversight. Thanks for watching, and if you enjoyed this video, be sure to give it a thumbs up and leave a comment below. Remember to subscribe.